How is money created? A straightforward, down-to-earth explanation. When people hear money creation, they usually think of massive printing machines churning out cash. But modern money doesn't work like that. These days, money is being made in ways most people have no idea about, out of sight, online, and mostly by banks. There are two main ways money is created: the central bank creates money, and commercial banks do too when they lend it out. And the surprising truth is this: most of the money we use every day is created by banks, not the central bank. Let's break it down with some real-life examples. 1. Money created by the central bank, the classic idea of printing money. Picture this: the economy is slowing down. The central bank wants to inject more money into the system. How do they do that? They give money to banks, buy government bonds, and cut interest rates. All of these actions create new money. But here's the main thing to remember: most of this money stays within the banking system as reserves. It's not something that's going to make people's pockets bulge. And what about all the physical cash printed at the mint? That's only a tiny fraction of the total money running the economy. The real source of most money: banks make money through loans. Now, this next bit is surprising to a lot of people. When banks give out loans, they're basically creating new money. Not from someone else's account. Not from stacks of cash in a vault. They make it digitally. Let's say you walk into a bank and ask for a $10,000 loan. The bank doesn't need to have that exact amount in the vault. It doesn't take money from another customer's account. So, what does the bank do? It'll put $10,000 into your account. And at that moment, new money is created. From that second on, the money is real. You can spend it at a store, send it to someone, pay bills. It goes around the economy like any other money. These days, 90 to 95% of all money comes from bank loans. In other words, when banks lend more, it means the economy gets bigger. When banks are less willing to lend, the money supply slows down. How is this even allowed? So, without this system, businesses couldn't grow, mortgages wouldn't exist, investments would crash, and economic growth would stall. The economy needs money to be moving all the time. So, here's the deal. Banks can create money by giving loans out. It's the central banks that control this process, with their rules on reserves and regulation. Banks have to keep a bit of the money as reserves, so they don't lend too much and mess up the system. Money disappears when loans are repaid. This is the bit that people most often get wrong. When you take out a loan, money is created. When you pay back that loan, the money is gone. It's just like the ups and downs of the economy: we're always breathing in and out. In and out. That keeps the system balanced. Here's a simple real-life scenario for you. You buy a coffee for $5. Where did that money originally come from? So, someone borrowed money to buy a phone, right? The phone company paid its suppliers, who then paid their employees. And those employees went to the supermarket, where they spent the money they earned. Then the supermarket used that money to pay its wages. One of the team members treated themselves to a coffee at your cafe. One loan can end up in dozens of hands, creating movement, income, and activity. That's how new money powers daily life. The risk of this system: if banks lend too much, there's more money in the economy, which leads to inflation. If banks stop lending, there'll be less money flowing around, which will freeze economic activity. So the central bank is always tweaking interest rates to keep a handle on credit demand. If interest rates are high, fewer loans are made and money creation is slower. But if rates are low, more loans are made and money creation is faster. Money creation is at the heart of modern economies: too fast and the patient overheats, too slow and the patient collapses. The core idea: money is basically just a bunch of numbers. Most of the money we use these days isn't physical. It's just numbers on a bank's balance sheet. But the moment you spend it, those numbers turn into real value. So, you've got to think about the rent, groceries, transportation, salaries, bills, and so on. In short, money exists because the economy keeps going. It's created through credit, and it disappears when credit is paid back. This is how money is actually created. It's simple, you can't see it, and it happens all the time.